When we think about Hill Partners as a whole, when we invest capital, we back people. And I think you back people in every facet of life, particularly when you have, an employee-employer relationship, or when you have a service provider. And what reason why you keep going back to that same place every morning and getting the same coffee is because you're dealing with that person and you're backing them. That becomes incredibly important in the investment world. And so if we look at the calibre of the individuals that have got behind Hill, most of them have already been incredibly successful in their working lives. In fact, I go as far as saying they don't even need to do Hill. But they're doing this because they're opening up an investment club for individuals who want to come in and co-invest alongside the founding partners. And if that's sort of not enough for us or our investors out there or the audience, I'd go further than that and say some of your viewers out there would know a group called Tiger Funds Management, run by a fellow called Julian Robinson, very, very famous investor around the world. And you could argue Tiger Funds Management have been the most successful hedge fund in the globe for the past 30 years. Julian has actually personally put capital into some of Hill Partners' investments as well, in particular Crimson Education, where he backed an individual that used to work for him that founded that business. So when we're looking at Hill, yes, we're looking at the right people to back, just from a portfolio management perspective. But if you look at their investment track record in terms of finding businesses early on, scaling them, growing them, and then selling them at very high multiples down the track at a much higher rate than what they invested into those businesses initially. And that's now being vindicated by the likes of Julian Robinson and Elliott Management for Fund 2. We just think they're a quality outfit as a result of that, and they've been vindicated around the globe. If you think about investing and take that approach to another industry, let's say the medical industry, if you go to your GP and get a health checkup and your GP requires you to go after different specialists for different parts of your body, you go to those specialists. That's how we see Lucerne effectively as that GP. And then when we look to allocate capital, we look to allocate to specific specialists instead of pretending that we can do that all ourselves. So we find that for our investors, it's better off spending a lot of time and research on doing due diligence on experts within their respective fields. And the investment universe, it's a very complex beast at the best of times. And therefore, as a result, we do feel that partnering of capital with experts is the most appropriate way to go from that perspective. Everything from bonds to fixed income to private debt to equities to digital assets, which has become a big theme in the market. With that thematic in particular, you would argue you need to be with experts within that space. It's such a new thematic in the market, and we don't want to pretend for one moment that we are experts, but we think we're good at picking people and good at picking managers that are at the forefront of their respective industries. When selecting a manager, one thing we look for is size. I think in financial services, a big thing that people discount is size. And what I mean by that, most industries around the world, the larger you get, the more pricing power you have, the more market share you have. Think about Nike from a sports apparel perspective. They own market share, they own significant market share, more than 50% globally. When you think about financial services, the larger you become in this space, the more inflexible your mandate becomes. If you think about it from an analogy of a ship turning, the larger a fund becomes, the more they become like the QE2. The more smaller and nimble a fund can remain, the more they're like a speedboat or a jet ski. And we prefer the latter when allocating capital, because markets can be volatile, they can move quickly, so we want flexibility within our managers. And so probably that's the first key point, that size actually does matter in funds management to the lower side. We want managers to remain small and nimble, and we want them to commit to managing a finite pool of capital. Often what we've seen over time is some of these managers, their performance is great in the early years, then potentially greed can come into that, and so they're going to try and run more and more capital, and then that inflexibility comes into place. So for us, flexibility is important. How do you control flexibility? By the size of capital that you're committed to managing. In addition to that, another really important point for us is alignment. We want to see skin in the game. So most of our managers are primarily remunerated on performance, so they need to perform to be paid well. But furthermore, we want a good understanding of how much of their own personal wealth outside of their family home they have invested in their strategies as well. And so we look at that and we look for alignment. And furthermore, you want to see a track record. Quite often, like in many industries around the world, when a business starts up, that individual starting that business has generally spent more time, or has spent time previously in, say, a larger firm or a conglomerate, and they felt that they can do this better themselves. And that's what you see in funds management as well. Often some of these individuals that are very good fund managers have cut their teeth in larger organisations, so we can get a good feel of track record before we back these managers. And probably the final point is we want to be early. In funds management, quite often a number of investors are waiting for a fund to be rated, or institutions are waiting for a 3-year track record. And there's enough theory out there that shows that often fund managers and investors as a whole actually have their best performance in their earlier years when they're small and nimble, coming back to that point. So we like to be there before the institutions. We like to be there before they've won all their awards. So we're happy to be early to the party, but we certainly don't want to be last to leave. So combining all those sort of key criteria together is what we go through when selecting a manager. What really attracted us to Hill was the personnel behind Hill, that the founders and partners had all invested with each other for quite a period of time, that all had been incredibly successful in their respective lines of work. And they almost brought together this investment club to start Hill Partners. They were committed to staying small, part of our investment thesis. They recently hard closed their first fund at 145 million Aussie, which is incredibly small for a private equity fund. So we knew they could be flexible, and that really attracted us to the portfolio. So the team, the size of the portfolio, but probably the most important point with Hill was we already had a really good line of sight into what that portfolio was going to look like. So they already had existing investments within the portfolio before we invested. We knew that the founding partner team often would take board seats or already had significant personal wealth invested in some of these companies. So again, with that alignment thesis, we knew they were highly aligned to these investments. We knew they had a lot of control over these investments, know-how, and also say with these companies. So those were the key points that attracted us to Hill, and that allowed our investors to come in at what we felt like was really a significant discount to what we felt that underlying portfolio was actually going to be like in, say, 12 to 18 months' time, which is a short time in private equity land, and that thesis has absolutely played out.